Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Really the Fed wants most of us unemployed. And if you don't believe me, then watch this video because we're going to show you exactly why.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, so a lot of times when the Fed talks, you got to read between the lines of what they're saying, and I think you dug up some data that pretty obvious of where they're trying to push things. So I was just curious, how you see this going.
Hey, Phil, before I get started, why don't you just throw the chart up there too so people can look at it while we're talking? Look, the Fed has been really, really clear here, but the Fed also has a problem. And my personal view is that I think the Federal Reserve, the bankers think that there's too much speculation that went into real estate and went into the stock market, and we have an imbalance. And the United States government has a need for more domestic ownership of their treasury bonds and their treasury bills. As we looked at yesterday, our podcast, some countries are selling treasuries because they have to, and some are selling treasuries because they want to. And we also have our domestic banks that have a duration problem. And I think the Federal Reserve and the banking system would rather have more of these bonds owned by the domestic investor than the Federal Reserve and the banking system. But as you can see how stubborn the market has been, basically the market hasn't gone really anywhere for 6 months now. Mm-hmm. Is that, and the Fed raising interest rates, is that they're going to get people to sell. And we talked about this in our room this week, is that, the only time you're really going to sell your stocks if you lose your job when you didn't want to, and you're going to have to start living on that money.
Right.
And I think that's, a playbook that they've used in the past. Just check it out, guys. Whenever the Federal Reserve can institute a policy that causes higher unemployment, it drives the stock market down. And when you drive the stock market down, the first place money goes is into the quote unquote safest asset in the world, treasury bonds. And I think that's what's happening here. And you don't have to take my word for it. Listen to the talking heads. And Phil, you have some tweets that you could throw up here and talk about.
Yeah, and I agree with you. I mean, it's going to be a bullish bond market, I think, going forward. We already saw the shift in the start of that 3 weeks ago, and that's when gold and Bitcoin jumped. And you're going to see those be safe haven assets too. So that whole scenario is playing out. But going back to these tweets, this is what they put out there, and you kind of have to read between the lines. But Fed's barking says labor market is tight and inflation is too high. Powell says, I don't think we need a significant increase in the unemployment rate, but we'll need softening in labor market to get to 2%. Whenever they tell you that kind of thing, like they don't think they need a significant increase in unemployment, you're going to get a significant increase in unemployment. And it's pretty obvious too, because if you go back and you look at this chart, I mean, all of the major drawdowns in the market come with significantly higher unemployment. So it's just a joke when they tell you they don't think you need significant unemployment. The fact of the matter is we're going to get significant unemployment if the Fed gets their way. They just can't say these things because it's too controversial and they think the Fed will be reckless. But their mode of communicating is boiling the frog slowly. Fed's Cook down here at the bottom says, the data print a clear picture of historically strong labor market with persistently high inflation. So again, what they're saying is, get ready for unemployment rates to go up. And, at the end of the day, they're going to be able to go back and say, well, we said unemployment had to go up for this to happen. And it should be no surprise to anybody. But the way they present the data, it's almost like the Fed has their own speak and you kind of have to read between the lines of what they're saying. But really what they're saying is get ready because there's going to be a lot of unemployment coming because we're going to keep cranking on these rates. And as long as the market is hanging out up here, and a lot of what we're seeing is this quarter end kind of window dressing stuff, but we're not seeing a lot of flow flows from the banks. In fact, the banks are parking more money overnight in the reverse repo. Yeah, the Fed expanded their balance sheet, but a lot of that was backstopping those banks. And so I think they're probably implying that those banks are going to have to do something else with the money other than speculate in the stock market, because that's going to go against what the Fed's trying to do, and that is to bring asset prices down. So asset prices down, unemployment up is what the Fed's telling us. You just have to kind of read between the lines to get that message clearly.
Yeah, and we're in phase 2 now, because I think the increase in rates are where they think they have to keep them, because it'll start harming the federal government's ability to pay the interest on these notes. And now they're just going to basically choke you out.
Right.
And you're just not going to get access to credit. You know, right before you jumped on with me, the podcast, I was reading about insurers are in big trouble now. And then also another note came out that said that they feel the employment is at full employment right now. So they're trying to create the base case saying, hey, we haven't really done our job yet. And I think they're just you're gonna see balance sheet roll off. You're gonna see them forcing, basically credit out of the system. And without credit, companies are gonna have to retrench. When you retrench, that's a euphemism for I'm gonna lay you off.
Right.
And I think that's what's going to happen.
Yeah, I think once the debt ceiling debate, whatever comes of that, finally gets lifted and they all agree, I think Yellen's going to drive her balance straight up in the air, because she's going to have to get caught up on all the debt that she hasn't been issuing. They're used to issuing debt regularly. They haven't really been able to do that since March February, January, somewhere in there. A couple months ago, they had to stop issuing new debt because of the debt ceiling got hit. So when her balance goes straight up in the air, that's liquidity down for the markets. The Feds knows that. And so I think they're just kind of letting things go here. But I think the push is going to be in the second half of the year. We've been talking and warning about things getting worse. And it's really, that isn't like a week to week call. This is more like, over the next coming quarter call. And we definitely see that headwind coming. But I think it's really going to start manifesting after the debt ceiling raises. And the retail public's going to go, oh, yeah, the debt ceiling got fixed. So, kumbaya, right? But no, you're probably going to have a negative effect. And it might be a head scratcher for some retailers that are thinking that's a bullish sentiment, when in reality, the way that things work under the hood, it's going to take liquidity away from the system, pull it into the bond market, and continue this bullish bond market. And then I think gold and Bitcoin benefit from that as well.
Yeah, and I think they have to do it, because once Yellen starts issuing debt again, the yields are gonna go up on their own.
Right. And
if there's not a buyer for that, that's bad news. Bad news for the stock market for sure. Bad news for people who have to borrow money for sure. But it's good news for other assets, and maybe we'll talk about those later this week on what environment is going to thrive in this scenario that we're laying out. And make no mistake about it, they have no choice but to drive domestic demand for U.S. Treasuries because of the geopolitics out there and just the internal economic need for people buying these debt instruments. So stay tuned. Phil, this is I think a great thing for people to understand. And, if you guys want to hear more about this stuff, hit like, get your notifications from us, subscribe, tell your friends, and, we'll help you navigate through this, because these are the things that people, basically what Phil said, boil the frog. We're going to wake up one day and the frog's going to be cooked. And people right now are just sitting there saying, everything looks blue skies to me. They just have to turn around and see the cloud coming at them. So
hope you guys like frog legs.
That's for sure.
All right. Well, thanks guys for watching. Please hit like and subscribe, and we'll see you on the next video. Take care.
Trade Genius.